They said it would never happen. The safest debt on earth, quietly sold by one of America's closest allies. In a single month, Canada offloaded $57 billion in U.S. Treasuries. Not China, not Russia. Canada, the country whose currency, economy, and defense are all tied to Washington, just walked away from the cornerstone of U.S. finance, and nobody in D.C. wants to explain why. Was it protection, protest, or preparation for something bigger? Because if even Canada is pulling its money, what does everyone else see coming that the United States refuses to admit? According to the U.S. Treasury's July 2025 tick data, Canada's holdings of U.S. Treasuries fell from $438.5 billion in June to $381.4 billion, the largest single-month reduction ever recorded for Canada. Bloomberg confirmed that even during China's heaviest sell-offs, the flow never looked this steep. Traders who saw the figures described it as a controlled detonation in the global bond market. Within 48 hours, the 10-year U.S. yield spiked 15 basis points, its sharpest move in 6 weeks, while futures on the S&P 500 lost 1.4%. Reuters reported emergency calls between the U.S. Treasury and several G7 finance ministries as Washington tried to determine whether this was a one-off reallocation or the start of a coordinated retreat from U.S. debt. Canada's finance department declined to comment. The silence was deafening. The first hypothesis was currency adjustment. The Canadian dollar had appreciated 2.3% in July, which can mechanically reduce the US dollar value of holdings. But when analysts at TD Securities decomposed the move, they found less than $9 billion could be explained by FX. That left nearly $48 billion of active selling. That scale implies a policy decision. The timing is awkward. In March 2025, Ottawa issued $3.5 billion in US dollar bonds, its largest such sale since 2018. Claiming it wanted to broaden access to international investors. Now barely 4 months later, it is unwinding dollar exposure from its reserves. The juxtaposition, as the Financial Times noted, suggests a deliberate reshaping of reserve composition rather than portfolio noise. For decades, Canada has functioned as the United States' financial twin. Mirrored economies, synchronized cycles, integrated supply chains. Roughly 75% of Canada's exports still go south of the border. Yet that dependence is starting to look like a liability. Donald Trump's second-term trade agenda, built on renewed tariffs and continental rebalancing, has redrawn the incentives for even friendly nations. In May, Washington slapped a 10% tariff on Canadian steel and 5% on aluminum, arguing national security grounds. The retaliatory levies from Ottawa arrived within days. Trade friction now bleeds into finance. Canada's bond sell-off can be read as both a hedge against the U.S. policy cycle and a warning shot. Still, analysts hesitate to frame it as rebellion. A senior economist at Scotiabank told Reuters, "There is no evidence Canada wants to undermine the dollar, but there is clear evidence Ottawa wants insulation." Insulation from what? From volatility that no longer obeys fundamentals. The U.S. fiscal deficit, according to the Congressional Budget Office's June update, is running at $2.1 trillion for 2025, equal to 7.6% of GDP, even with unemployment below 4%. That imbalance is forcing the Treasury to issue roughly $1 trillion in new debt every 90 days. In July, the Treasury announced auctions totaling $119 billion across 3, 10, and 30-year maturities. Each tranche will test whether foreign demand can keep up. But if a G7 ally is trimming its exposure, the question becomes existential. Who replaces them? Japan remains the largest foreign holder at $1.06 trillion. The UK follows with $722 billion. China lingers near $757 billion, its lowest since 2008. Together they account for half of all foreign-held treasuries. Canada's share, now under $400 billion, looks modest, but its trajectory matters. Allies rarely move first unless they've already seen the direction of travel. By August, whispers spread that Ottawa's move was preemptive. According to Bloomberg Intelligence, several sovereign funds, including those of Singapore and Norway, quietly trimmed U.S. bond exposure during the same quarter. The pattern hints at what J.P. Morgan strategist Jay Barry called a portfolio rotation rather than a panic. Rotation into what? Gold for one. Central bank purchases of gold hit 290 tons in the first half of 2025, the strongest pace on record per the World Gold Council. The Bank of Canada officially holds no gold, but its pension and sovereign fund arms have ramped exposure to gold-linked ETFs by 38% since January. Another channel is Yuan settled trade. Canada's exports to China reached 16 billion Canadian dollars in the second quarter of 2025, up 6% year over year, driven by copper ore and crude oil. More than 20% of those deals were denominated in renminbi through the Shanghai clearing hub compared with 9% a year earlier. That shift reduces Ottawa's need to hold US dollar reserves for invoicing. This aligns with a broader pattern. The IMF's COFR data shows the dollar's share of global reserves fell to 58.4% in the first quarter of 2025, the lowest since 1995. The euro sits near 20%, the yen 5.3%, and the yuan 3.2%, still small but climbing steadily. For Canada, diversification isn't ideological, it's actuarial. The more Washington weaponizes access to dollar clearing, freezing assets, sanctioning entities, and forcing extraterritorial rules, the more even friends calculate counter-risk. Scott Bessent, the current U.S. Treasury Secretary, insists this reconfiguration is temporary. In an interview with the Wall Street Journal on July 30th, he argued that U.S. debt remains the safest and most liquid asset in the world, and that short-term portfolio shifts should not be mistaken for structural exits. Yet the bond market seems unconvinced. The 30-year yield has climbed 64 basis points since Trump announced new tariff rounds in April. At the same time, gold's rally has broken every historical ceiling. Futures crossed $4,000 an ounce on October 7, 2025 for the first time ever. Goldman Sachs raised its 2026 target to 4,900, citing persistent official sector accumulation and Western ETF inflows. For context, that's a 22% potential upside from today. This movement effectively flips the 40-year script. From U.S. debt is safety to U.S. debt is yield risk. If central banks are exchanging treasuries for bullion, it's not about return. It's about survival in a system whose issuer treats debt like an instrument of politics. Canada's sell-off also coincides with domestic stress. The federal budget deficit, projected at 39 billion Canadian dollars, is being financed amid the most expensive borrowing conditions since 2007. The Bank of Canada's benchmark rate stands at 2.75%, but 5-year mortgage rates hover near 6%, squeezing households and curbing growth. Maintaining liquidity in Canadian dollars, rather than hoarding U.S. paper, serves both fiscal and political logic. Meanwhile, U.S. internal demand for its own bonds is softening. Primary dealers who are legally obliged to bid at Treasury auctions are absorbing a growing share of new issuance, over 25% in the latest 10-year auction, up from 14% a year earlier. The foreign bid, historically near 60%, has slipped under 50%. This gradual attrition translates into higher long-term funding costs, compounding the deficit spiral. The IMF's July Fiscal Monitor warns that if average Treasury yields stay above 4.5% through 2026, U.S. interest payments could exceed defense spending within 2 years. That scenario would make every foreign exit, even a modest one like Canada's, exponentially more painful. Still, correlation is not causation. It's possible Canada's move was, just technical, maybe adjusting reserve durations or offsetting corporate issuance. The Bank of Canada hasn't published any statement confirming deliberate policy diversification. Still, markets trade on perception, not disclaimers. And right now, perception definitely tilts toward doubt. A Reuters analysis on August 14th noted that the geography of trust in U.S. debt is shrinking. Since 2020, foreign holdings as a share of total U.S. debt have dropped from about 1/3 to just under 1/4. That's the quiet de-globalization of the bond market. Parallel to that contraction, a new pattern is emerging: internal concentration. These days, Japan, the UK, and Luxembourg together account for more than 2/5 of all foreign-held treasuries. Canada's retreat, while small in numerical terms, actually widens the imbalance, putting more weight on fewer shoulders. If just one of those major holders were to flinch, liquidity could disappear even faster than it did in 2008. The paradox of this reset is that it isn't ideological, it's mathematical. When the world's reserve asset yields 4%, but the currency backing it loses 10% of purchasing power in just half a year, well, the equation stops making sense. Investors might chase nominal yield, but they're losing real value. That's why Ray Dalio warned at the Milken Institute conference in May 2025 that the era of free financing for the U.S. is ending. He added, all empires go through a stage where debt outpaces productive capacity. Ken Griffin of Citadel echoed the concern on CNBC in June, saying, if allies begin treating treasuries as risk assets, it means the trust premium, which made the dollar unique, is gone. The world is right now testing that hypothesis in real time. Consider the chain reaction that's already visible. The dollar index is down 12% since January. Oil prices have climbed 18% and gold, the ultimate mirror, has surged 51% year to date. These aren't just random movements. They actually form the perimeter of a global repricing. Inside Washington, policymakers still describe these shifts as market noise. But honestly, the noise now resembles an alarm. Behind closed doors, sovereign risk desks across Europe and Asia are running simulations that were once considered purely academic. What happens if U.S. debt loses its risk-free status? The European Central Bank's internal memo, which leaked in July, proposed creating a G7 reserve basket, a weighted blend of U.S., Eurozone, and Japanese debt, to reduce dollar dependence in institutional portfolios. In Ottawa, a similar kind of calculus might be underway. The Canadian Pension Plan Investment Board, which manages $755 billion Canadian dollars, disclosed in its June report that it had reduced U.S. fixed income holdings by 11% and increased exposure to infrastructure and commodities. So if national pension funds and central banks are both leaning away from treasuries, the reset isn't some kind of conspiracy. It's really just an accounting adjustment to new risk realities. As for the United States, the answer so far has been more issuance. The Treasury's financing blueprint projects gross borrowing needs of nearly $7 trillion for fiscal year 2025, up from about $5.3 trillion the year prior. Each auction succeeds, but at progressively higher costs. That treadmill effect, really defines late-cycle debt systems. Every solution just deepens the original problem. The dollar's decline has consequences that extend way beyond spreadsheets. Import prices are climbing. The Bureau of Labor Statistics' August report shows goods inflation re-accelerating 0.6% month-on-month, which is the largest uptick since 2023. And when a reserve currency weakens, domestic consumers pay the price long before bond investors do. Meanwhile, the rest of the world adjusts. China and Saudi Arabia expanded their Yuan settlement agreement in July, covering $25 billion in annual crude trade. India announced a rupee dirham payment corridor with the UAE. Brazil and Argentina began settling select trades in local currencies. Each deal erodes a fragment of dollar circulation, individually minor but collectively systemic. The reset is not a switch flipped overnight, but a sequence of silent trades like Canada's, months apart, billions at a time, rewiring global finance without headlines. In the past, financial crises were explosions. This one is erosion, balance sheets rebalanced, reserves reweighted, confidence repriced. Back on the trading floor, the chart of U.S. 30-year yields glows crimson. Algorithms still churn, bids still print, but under the noise there's recognition that, something foundational has shifted. For years, investors believed the United States could borrow indefinitely because allies like Canada would always show up to buy. Now that certainty is gone. So the question lingers across Bloomberg terminals and bond strategy desks alike. If even Canada is quietly stepping back from America's debt, what happens when trust itself goes on sale? We're glad you're enjoying this video. Please like and subscribe. And hey, check out another video that is now on your screen.